Hey, welcome. Every single business on the planet, no matter how big or small, speaks one language, and that language is money. So today, we're going to decode it. We're going to break down the key financial statements and really see the story they tell about a company's health and its future. So really, what do they have in common? It's not the size, right? It's not what they're selling. The secret is that they both rely on the exact same financial language to figure out if they're succeeding, to make big decisions, and to plan out their next moves. And look, getting a handle on this language, that is the first, most critical step to take your passion project and turn it into a real, lasting business. Okay, let's be real for a second. You've got this great idea, right? Maybe it's a gourmet popcorn shop, we'll call it Cheesy Chuck's. You're pouring your heart into it, you're working crazy hours. But that one big question is always there, kind of hanging over your head. Is this amazing idea actually a great business? I mean, these are the exact kinds of worries that keep founders staring at the ceiling at 3 a.m. And here's the thing, a gut feeling just doesn't cut it. You can't walk into a bank and say, I have a really good feeling about this. No way. You need hard facts, you need data. You've got to speak their language. So, what's the solution? It's like finding a Rosetta Stone for your business. It's a set of 4 key reports called financial statements. And when you put them all together, they tell the complete, honest story of how your business is really doing. All right, let's dive into the first one. This is the statement that answers probably the most basic, most important question any business owner has. Plain and simple, did we actually make any money? The income statement is basically your business's report card. Now, it's not looking at your bank balance, not yet. It's looking at your performance over a set period of time, say a month or a quarter. And it really just comes down to 2 things, what you brought in and what went out. First up, you've got revenue. This is basically all the money you earned from doing what you do. So for our friend Cheesy Chuck, it's the value of all that amazing popcorn he sold. And then, of course, you have expenses. This is all the cash you had to spend to make that revenue possible. You know, the popcorn kernels, the rent on the cart, paying your employees, the whole shebang. And this is where it gets so simple, it's kind of beautiful. The entire income statement boils down to this one super powerful formula. You take your revenue, you subtract your expenses, and what's left is your net income. You've probably heard it called the bottom line. Okay, so let's see how this plays out for Cheesy Chuck. He brought in a cool $85,000 in revenue. Awesome. Then we subtract all his costs, the supplies, the wages, everything, which adds up to $79,200. And what are we left with? A net income of $5,800. Hey, not bad for the first month. The bottom line is clear. He made money. All right, so the business made a profit. That's great news. But what does that actually mean for Chuck, the owner? Like, how does it affect his personal piece of the pie? Well, that leads us right into our next statement. This one's called the Statement of Owner's Equity, and it's all about tracking the change in the owner's personal stake. So you start with whatever the equity was at the beginning of the period, you add in any new cash the owner personally invested, and then, and this is the magic link, you add that net income we just figured out, that $5,800. Finally, you subtract any money the owner took out for themselves. So for Chuck, it was his first month, so he started at 0. He put in $12,500 of his own savings. We add that $5,800 profit we just found. Then we take away the $1,450 he paid himself, and that leaves his final ownership stake, his ending equity, at $16,850. Now remember that number, it's going to be important in a minute. Okay, so now let's see where that number pops up next. If the income statement was like a report card over a whole month, our third statement, the balance sheet, is more like a financial selfie. It's just a snapshot of your business on one single day. It answers a really simple question. Right at this moment, what does my business own? What does it owe? And what's left over for me? It gives you that perfect picture of where the company stands financially. And this whole thing is built on one core idea, the basic accounting equation. Everything you own, your assets, has to equal the claims on those assets. It has to balance. It's not optional. And here's why. Every single thing a company has, whether it's a dollar bill or a giant machine, had to come from somewhere. It was either bought with borrowed money, that's a liability, or with the owner's money, and that's the equity. So, to put it simply, assets are the useful things the business owns, like the cash in its bank account or the fancy popcorn machine. Liabilities are what the business owes to other people, like an unpaid bill from a supplier or the wages you still have to pay your employees. And check this out. Here's how it all clicks together for Chuck. His assets, that's his cash and his equipment, add up to $18,700. On the other side, his liabilities, what he owes, are $1,850. And his owner's equity? Hey, there's that number. It's the $16,850 we carried right over from the last report. And boom, both sides equal $18,700. It balances perfectly. You can literally see how all the pieces of the story are connecting. Okay, we're almost there, but there's one final, really important piece to this puzzle. We know Chuck's business is profitable, which is awesome. But here's a question. Is being profitable the exact same thing as having cash in the bank? The answer is not always. And this is a super important distinction to get. See, most businesses, including Chuck's, use what's called the accrual basis. That just means they record revenue when they earn it, not necessarily when the cash hits their hand. Think about it. A mechanic fixes your car today. He's earned the revenue today, even if you don't pay him till next week. So a company can look really profitable on paper, but be totally strapped for actual cash. And that's exactly why we need the fourth report, the statement of cash flows. It just follows the money. It shows you exactly where cash came from and where it went by looking at the day-to-day operations, like buying that popcorn machine, and financing activities, like when Chuck put his own money in. A business can be profitable, for sure, but if it doesn't have positive cash flow from its main operations, that's a huge red flag.
So when you step back and look at all of these statements together, you finally get the full picture. It's like a complete health checkup for your business.
Think of it like this. The income statement tells you if you won or lost the game this month. The statement of owner's equity shows you how your own score changed because of that game. The balance sheet, that's the team's overall season record frozen on one particular day. And the statement of cash flows tells you if you've got enough money in the bank to even show up for the next game. See, they're all telling one big, powerful, interconnected story. So you see, learning this language, it isn't just about doing math. It's about understanding the story your business is telling. It's about making smarter decisions. It's about taking that amazing idea you have and turning it into a truly great business. So really, the only question left to ask is, what story will your numbers tell?